It means also that the rate of return that they would give out, it won't be forever. There will be a limit for that. There will be a cutoff date for that. And please do have that in mind also, because once the rate of return, once the interest that they're giving out is not anymore satisfactory to you, then you must transfer. You must move your money to other assets that will get the rate of return that you like. Yesterday's video, we talked about how you could massively increase your portfolio by being diligent and using passive income and compounding to make your money grow over a long period of time. In that video, I gave an example using a 7% computation on how you can compound your earnings. I got some questions asking where can you invest that will give you a 7% return. So in this video, I want to zero in on asset classes, or at least strategies on how you deploy your capital towards assets that could give you a 7% return. But before I continue to talk about that, please do remember this, that if you go for a 7% return, there's two types of investments that are out there. One that will give you a fixed type of return, and second that will give you a variable type of return. If you're going strictly for those that will give you a fixed type of return, what you set in, when you place money at the start, you can expect the same amount of return on a regular basis. However, that will give you also a limit, meaning you won't earn more than that also. But in a way, that limit is what will also protect you in a way that at the end of it all, you won't see any volatility, you won't see any drops as compared to the capital that you actually placed in. So to make it super simple, some investments that could give you around 7%, that the revenue is fixed, and also your capital is somewhat not as volatile, is first you can search and try to look at for high yield savings accounts. Please do note that this may not be something that's traditional in a way, because majority of savings accounts, majority also of bank will give you a relatively lower rate of return, will give you rates of return that are below inflation. A lot of the digital banks that give you higher rates of return in terms of savings accounts use a portion of their funds for user acquisition or even for marketing to draw in more users. And part of that is they're giving higher rates of return for people to get into their platform. It means also that the rate of return that they would give out, it won't be forever. There will be a limit for that. There will be a cutoff date for that. And please do have that in mind also, because once the rate of return, once the interest that they're giving out is not anymore satisfactory to you, then you must transfer. You must move your money to other assets that will get the rate of return that you like. Second is you can go towards bonds. So this is still under fixed investments. You can go under bonds, and it could either be corporate bonds or it could also be government bonds. But basically, bonds are fixed income securities which are issued by either the government or municipalities and or corporations. So if it's a municipality or it's a government, that's under government bond. If it's a corporate bond, naturally it's issued by companies as a form of debt. They provide a predetermined interest rate, coupon, and return the principal amount at the maturity. Certain bonds, such as high-quality corporate bonds or government bonds, can provide stable returns of around 7% or more. We are in an era also where interest rates are quite high, and since interest rates are quite high, you have the ability actually to earn more as corporations are giving you a higher rate of return. So if you're asking me what's my preference in terms of corporate bonds or government bonds, I have a mix of both. However, it would be nice to have corporate bonds because that will give you a higher rate of return. Please do note though, if you hold it till maturity, you skip off the volatility and the same amount of money that you put in would be returned to you. However, you have to realize this, that since you're lending money to a corporation, corporations can go bankrupt. That's why the higher you go into the risk spectrum, the more you need to spend time to actually study, especially if you're putting a larger amount of money for corporate bonds as well. Those are two already. You can go for high-yielding savings accounts or digital banks. And then number 2, you could go for bonds. And if you're going to split bonds, it could either be government bonds or corporate bonds as well. Number 3 is you can enter into the stock market. Investing in the stock market for long-term capital appreciation, I think, works. And it allows investors to become partial owners of companies. If you look at the S&P 500, you look at fundamentally sound stocks in the US, or even if you look at indices, even in the Philippines, theoretically, or if you look at it from a historical standpoint, they should beat 7%. It doesn't mean they give you something higher than 7% yearly. However, when you look at it from a longer term perspective, you look at its compounded annual growth rate, there's a chance that on years that they're bad or lower than 7%, they could be compensated for years that where the earnings are greater than 7% as well. But historically, it should be better than 7%. That's one way to actually look at it from a capital appreciation perspective. When you sell it at a certain point, for example, you sell something for 4 years, that should compensate for at least getting more than 7% on each of the years while you are actually holding it. So it doesn't mean that you earn quickly that 7% in 1 year. It just means that effectively also when you take profits on it, it should be something that you should get more than 7% from a yearly perspective. So I'll segment it even further. So number 3 is the stock market. And please do note that when I say the stock market, it's for capital appreciation. Your money anymore is not fixed. There could be a lot of volatility. Then number 4, highly connected to the stock market. It's still stocks, but dividend-paying stocks, with your entire narrative is to buy the stock and find company that would give out a dividend yield higher than 7%. And this one, I think, requires more research and also timing on when you start buying it. Please do remember, I've made so many videos about this, that when you have the dividend yield, when the stock prices go down and the dividend stays the same, there's a bigger chance that your dividend yield would actually be higher. That's why I said timing. So for dividend stocks, when it drops, look at the stocks. If it gets you a dividend yield higher than 7%, that's when you start buying them. But if they don't give you the yields that you want, you could either go to the other assets we mentioned or just be patient, because one thing I know about the stock market is that it's cyclical, and as it's cyclical, as drops happen, it gives you the ability to be able to stack and add into stocks that you want and with the dividend yields that you want as well. Number 5, highly connected still to the stock market, is real estate investment trust. REITs are companies that own, operate, or finance income-generating real estate properties. They offer an opportunity to invest in real estate without the need for direct property ownership. REITs typically generate income through yields and can provide investors with attractive returns, including a potential of 7% or higher. Now, this one also, though, your technique should be also the same as how you would treat dividend stocks. When the stock price is down, check the dividend yield based on the dividends that they're giving. If it's above 7%, then you can start buying them. Connected to this, and I'll just include this in number 5, is rental properties. You could have a condo, you could have an apartment that you're renting out, and you can start to compute it as well. The cost that you've put in, acquisition, construction, everything else in between, then the rent. What's interesting about this though is that you can control the rent, you can control the amount that you would charge monthly, versus going the REIT route where you're reliant on the dividends that they would give out as well. So I'll put them tandem, side by side, REITs and rental income properties. But the goal is for REITs, when the stock price is down, you buy it, you get your 7%. Or if your goal is rental income, then you look at the property and you adjust your rates in a way that you would get more than 7% or 7% that you're actually targeting. Number 6, also connected to the stock market, is you could look at index funds. Index funds are mutual funds or exchange-traded funds designed to track specific market indices such as the S&P 500. These passively managed funds provide a broad market exposure and aim to replicate the performance of the index they track. Depending on the performance of the underlying index, index funds can potentially generate a 7% or higher return. And this is the same playbook, in my opinion, as how you would treat buying stocks for the long term. Please do remember, when you're looking at index funds, the name of the game is you only make money when you sell and when you take profits off of it. So historically also, if you look at the S&P 500 or if you look at index funds that have a very, very good range in terms of diversification, they should beat the stock market also, I've seen different studies where index funds have performed better than actively managed funds. And if you look at it from that perspective and your time horizon is longer, from a yearly basis, it's a good way also for you to beat 7%. So if you notice it, a lot of the things that I've mentioned is highly connected to the stock market. You can buy individual stocks for capital appreciation. You could buy dividend paying stocks. You could buy REITs for the dividends that you receive off of it. You can also get index funds. So I want to add a seventh layer into this. You could look at also crypto. You could look at staking. You could either buy and then hodl it, and then when it hits a certain amount that you want or a certain percentage that you want over a cross period of time, and then you start to compute that it's above 7%, then you can start also taking profits. But another way also to look at it from a crypto perspective is to look at it from staking. That when you lodge your crypto to a certain platform, you get specific rewards either by validating the network or also locking in the tokens that you have as well and get a certain APY. So there are certain stable coins or there are certain platforms that if you lodge stable coins, you could get more than 7%. There are certain platforms also that when you lodge it towards tokens, you get even a higher rate of return. Please do remember though, when it's a token, there's a chance that the token can drop in value, that the loss that you get from the drop, the value of the token may be more than what you're actually getting in terms of the APY that you would get from the staking. For stable coins also, there's risks also that we've seen a lot of stories about how stable coins have depeg. It doesn't mean that it's a stable coin. It doesn't mean that it's not volatile, that there isn't risk attached to it as well. Please do your own due diligence and study, do your research, try to find something that fits you, because from digital savings accounts to bonds to the stock market and to crypto, they all present different types of risks. They all represent different types of time horizon. They all have different types of volatility. But what I do believe, and the numbers can also show you, that over a stretch period of time, these could give you above 7%. I know I've made this video to answer questions. If you guys have other questions, also put it down below in the comment section and I'll try to make videos based on the questions that you guys sent out. If you guys want to learn more about stocks, crypto, and everything else in between, check out the links down below for the seminars that I have, the books that I have, all of the videos that we've created here on YouTube. If you like this format, let me know. And I hope you guys got a lot from this. I hope this video helps you trade well, trade strong, trade smart. See you all again soon. God bless you all.